Alarming number of people still believe in investing myths. It is the same as believing that the earth is flat or is carried by a giant space turtle. Unbelievable. Hey Artyom, we live in 2020. You can't just offend people's beliefs anymore. You are right, Artyom. I'm sorry if you believe that the earth is flat. I'm genuinely sorry for you. And because of similar investing myths, some people still think that stock markets are a scam, that you cannot make money there, or such people just generally do not feel confident about investing. Let's destroy some of these myths. What's up, investors? My name is Artyom Dikarov, and today we will destroy some of the major investing myths. And hopefully, by the end of the video, you will see how ridiculous some of them are. And watch this video all the way until the end, because I promise that you will find some of these myths mind-blowing. And if you personally believe in one of them, don't worry, we will personally bust them together. So, my channel focuses on investing and personal finance, but I'm not your typical guru who will try to sell you an ebook or a course at the end of this video. No, I don't even have them. I'm primarily here just to make you feel confident about investing. And one of the biggest reasons why so many people still do not invest, it is because they believe in the following myths. The first myth, it is that you need to have a PhD in finance or you need to be extremely clever and smart in order to invest. Wrong. Investing, in fact, is very easy. And all you need to do in order to be a successful investor is to be an emotionally stable person and have very basic understanding of simple math. And I mean just like really basic understanding. Here is the test to see if you qualify. What is 60 plus 9? Let me know in the comments if you can solve this math problem. Extremely difficult. And speaking about being emotionally stable, investing is all about not selling your stocks when markets are going down. It also means not buying overhyped and popular stocks without your own proper research. You might have heard this phrase, buy your stocks as you would groceries when they're on sale. Stonks. Successful long-term investing is all about controlling your emotions, a little bit of fundamental analysis, and basic portfolio management. And if I'm absolutely forced to select, I would say that 69% of success in investing depends on how well you can control your emotions. 26.8% depends on research and analysis, and 4.20% depends on proper portfolio management. And controlling your emotions here is the hardest one, but the rest two are still very easy and basic. Besides, if you decide to do investing in index funds, you can completely eliminate fundamental analysis and portfolio management. This is why my honest recommendation for every beginner would be to invest in ETFs. Do it now. Alright, the second myth it is that expensive stocks are better. Wrong. Stocks are not like clothes. Price does not mean quality. High prices only mean that there is a limited supply and high demand for the same stock. No more than that. The way stock prices work is that if there are more people who are willing to buy particular stock rather than those people who are willing to sell the same stock, the price of the stock will go up so that the supply and demand will be equal. And the opposite is true. If there are more people willing to get rid of any particular stock than people who want to purchase the very same stock, the price will keep falling down until the supply and demand matches. Economics 101. For that reason, stock price needs to be the last thing you are looking at while making your investment decision. Unless you're a trader who is looking at the prices because he is doing technical analysis. In that case, yes, you should look at the prices, but if you're a classic long-term value investor, just forget about it. During dot-com bubble crisis, there were hundreds of tech companies which prices were extremely overvalued because there was huge demand for every single company that was related to the internet. But you know what happened? Cringe. There was so many billion-dollar companies with such small revenues or no revenues at all. And basically logical thing happened. And let me tell you what, there are tons of great companies with stock prices of less than even $50. Remember, price is not equal quality. Okay, the third myth is wait. Before we proceed, please consider liking this video and subscribing to my channel if you find my videos educational or entertaining. Or both. Many more things are coming and I have huge news for you next week. Don't miss it. Alright, the third myth is completely opposite to the second one. Some people think that if a stock is cheap, it is bargain. Wrong. Instead, cheap stocks are generally volatile and risky. You might think, well, it's just $5, not a big deal. But penny stocks are one of the riskiest investments you can make. Of course, there are dedicated professionals who make huge money dealing with penny stocks. And these people usually are called Brokers. Investing joke. Cheap stocks are not for faint-hearted people. Imagine if a stock just costs $5, and if it loses just $1, this is the representation of 20% decline. Think twice before investing in penny stocks, then think again and don't invest in them. Okay, the fourth myth says this: if your portfolio loses 10%, it needs to grow exactly 10% back to restore to its original levels. Wrong. This is just not how math works. The only ones who can be that bad with numbers are some people of the US government.
Hey, what's up? Can I have some beers and cigarettes?
I don't think so. Best I can do is gun.
Okay.
Slam that like button if you're from America. But yes, here is a quick example proving that if your portfolio loses certain percentage of its value, it will need to grow more just to restore to its original levels. Imagine your portfolio's value is 1000 USD American dollars. Then some random dude says some random stuff on random Twitter and you lose 20% of it. 20% of 1000 is $200. That's easy. And now your portfolio is worth $800. And if it grows back exactly the same 20%, it will only reach $960. Why? Because 20% of 800 is $160. And in order for your 800 portfolio to be back at $1000 mark, it needs to get 25% back. Because 25% of 800 is exactly $200. Mind blowing. The more value your portfolio loses, the more growth is needed just so that your portfolio will be back at its original levels. Finally, the fifth myth say that some companies are just too big to fall. Nani? Wrong. Not a single company is insured against going bankrupt. Even Microsoft, Apple and Tesla. I mean, it would take much more to destroy such companies, comparing to smaller and other not so well-known companies, but they can absolutely fail too. And sometimes it takes just one insignificant event which starts the chain reaction, which eventually ends up in the company filing for the bankruptcy. And usually such things happen unexpected, just like John Cena getting married. I bet you haven't seen this coming. Let me know in the comments if you're a man of culture and you understood this reference. If you're old enough, you might have heard about Enron scandal. Come on, what's wrong with this script? So Enron employed approximately 29,000 people, and it was major electricity, natural gas, communications and pulp and paper company. And they claimed revenues of nearly $101 billion in 2000. And Fortune magazine even named Enron America's most innovative company for 6 consecutive years. And at the end of 2001, it was revealed that Enron's reported financial condition was sustained by systemic and creatively planned accounting fraud. Straight to jail. And since then, this whole event is known as Enron scandal. Enron has become a well-known example of willful corporate fraud and corruption. And Enron filed for bankruptcy in the Southern District of New York in 2001. Just remember one thing: there are no companies too big to fall. As we say in Russia, the bigger the wardrobe, the louder it falls. I mean, blue chip companies have more stability and there are less chances of such companies going completely bankrupt, but not a single company is insured against it 100%. Always stay on top of the news and financials of a company that you are invested in. Okay, let me know in the comments if any of these myths were relatable, or if there are any other fake legends about investing that you think some people might believe in. And if you want to learn more about investing and realize how ridiculous some of these myths are, please consider checking my Patreon. The link is in the description. And that's all there is to it. Thank you all so much for watching, and let's make a million or two
Together.